name is Jenny Kassan. I'm the CEO of Cutting Edge Capital, which is actually a sister consulting firm to a law firm called Katovich and Kassan Law Group. And our law firm focuses on all the legal services that social enterprises need help with. And then Cutting Edge Capital focuses specifically on the needs of social enterprises who are trying to raise capital in a way that's aligned with their mission and goals for their future. What we think is really important is just to give people more options. Under existing law, if you're not an accredited investor, which means you have at least $1 million in assets, not including your home, or $200,000 in annual income, you don't generally have a lot of options. So even if you want to be an impact investor, you may not really be able to figure out how to make that happen. So what we really focus on at Cutting Edge Capital is finding tools that actually open up impact investing to everybody. And the main tool we use is called the direct public offering. And that's a tool where you do a registration at the state level with the state securities regulators, and that allows you to offer an investment opportunity of whatever kind you want. It could be equity, debt, revenue share, to the general public. You can accept both accredited and unaccredited investors, and our clients have been doing that now for a few years. We've had some really good success with it, and we find that when regular folks have the opportunity to invest in a social enterprise in their own community, people are really, really excited to do that. So for example, we have a client that's going to be building a new grocery store in a low-income community in Oakland, and that company was able to raise $1.2 million from California residents, mostly focused in the Bay Area. And people were just really excited to support something that's going to be helping a low-income community, and they're also going to be making a decent return on their investment. Every state has laws that make this possible. We have clients all over the country. We've done this in New York, Connecticut, Massachusetts, Oregon, Washington, Utah. So yeah, every state actually has the legal framework that allows companies to register their offering and be able to accept both wealthy and non-wealthy investors. Yeah, we're really surprised how few people are aware that this is possible. There's been a lot of hype around this new law called the Crowdfund Act, which is part of the Jobs Act, and a lot of people who are talking about it are saying, oh, for the first time, regular folks will be allowed to invest in whatever they want. And actually, this has been legal for decades. Ben & Jerry's did a direct public offering in 1984. They sold stock to Vermont residents. There's quite a few other companies that have done it, but it is still not very well known and not very commonly used. Well, I would blame a few different parties. I would say that a lot of lawyers and financial professionals haven't educated themselves about all of the different options that are available. So when small businesses come to them asking about how to raise money, they usually just tell them, you know, the mainstream way to do it. They either aren't aware of or don't want to go to the hassle of doing something that would allow them to accept investment from a larger, piece of the population. And yeah, I think also nobody really knows about it, and we find that when social enterprises find out about it, they're often really excited about doing it. Now, it's not the easiest thing in the world to do. You do have to do a registration process with the state, and there are fees that have to be paid. You have to create a prospectus. So, I don't blame businesses that decide it's not the right way for them to go, but I do wish that more people knew that it was an option that could be considered among the others that are kind of the more well-known options. Right. Well, so the Jobs Act was passed, was signed by the president in 2012, and it had a lot of different provisions to it. One provision that has not gone into effect yet is the crowdfunding exemption, and that creates a new exemption under federal law that will allow any kind of business to raise capital from the public and actually accept investors, both wealthy and non-wealthy, from every state. So in that sense, it's different from the direct public offering, because under the direct public offering, you do have to register in every state where you're going to be wanting to accept investors. However, there are some things about that new exemption that I think are going to make it very difficult to use. For example, you're not allowed to communicate directly with potential investors. You have to go through an intermediary website. There's a maximum on how much each investor can put in. It's capped at $1 million. You will have to have audited or reviewed financials if you're raising more than $100,000. You have to give people the right to pull out at the very last minute if people decide they don't want to invest after all. So there's just lots of things in there that were actually added to the bill at the very last minute, and I think maybe weren't very well thought through, that are going to make it pretty hard to use. So we think that people will still we'll just think of that as an additional tool in the toolbox, and may consider direct public offerings as a better option than that, depending on their situation. I think that we will see a lot of changes. One thing that we're seeing that's very, very interesting is many states are adopting crowdfunding exemptions now, because there has been some disappointment with the federal law that was passed in 2012. We're seeing multiple states coming up with their own exemptions, so that'll be really interesting to watch how that plays out. And then also, I think there is an awareness at the federal level that the crowdfunding exemption has a lot of flaws, and there has been talk about trying to improve that. But we think that, with the direct public offerings able to be done today under current law, there is an option that's pretty workable. We've had clients that have had a lot of success with it. So even without legislative change, it is still possible to open up impact investment to the general public. That's a really good question. I think that among retail investors, meaning those who are not the professional wealthy investors, I think it will be much more common, because from what I've seen with my clients is that when they do open up the opportunity to the general public to invest, people are really excited to invest in businesses that won't just provide a financial return, but are also doing good in the community, treating people well, taking good care of the environment. And people are willing to take what many would say are not super high returns, because they want to see their money doing good in the world, and they also really like investing in things that are in their own community, that are in their own backyard, that they can see what's happening, see that there's an impact, maybe even participate in some way, like be invited to an annual VIP event for investors, that sort of thing. So I think that will become much more common. In terms of impact investing at other levels, I don't know. I'm hoping, based on what I'm hearing at the conference, that it will become much more mainstream, but that remains to be seen.